Welcome to the B.F. Anderson Technical Report for February the 10th. This was a report where Fed Bullard says that he believes the unemployment rate can go below 3% this year. So basically, the problem with the economy right now really isn't demand and really not much of a fear of a recession. It's more dealing with inflation and interest rates. I thought this graph was interesting. I went back to 1983, and we go through rate hike cycles. So you can see that, each area shaded in gray is where we have the cycles where the Fed is raising interest rates. Well, back in 83, the market went up 20% during the cycle. 87, 89, 44% of this, was an increase in the market. 95, 4%, and so forth. So you can see here that in 2016 through 2019, a 28% increase in the market. So interest rates are important. However, they do not cause bear markets necessarily, at least historically. Now, I did want to remind you of the very important fact that the Millennials have now turned 35 years of age in 2016. Now, this is going to be the largest consumption sector of the population. So basically, I really don't think demand is going to be a problem for the Millennials. I think the real problem here is production. We need to get become more productive. Now let's just get into the market here. You can see the NASDAQ pulled back. Looks like it's forming a bottom here. We did rally, pulled back again. So it almost looks like a stair step and is picking up a little bit today. Actually still below the 35-week moving average. Now I've added a new indicator this week, which I call trend strength. Now what I'm doing is I'm taking 7 moving averages, starting with the 50-day moving average, going all the way out to the 250-day moving average, and then I simply look at the index itself and determine what percent of the moving averages is it above. So in the case of the NASDAQ, it's 0. So trend strength is not strong for the NASDAQ, but could be improving. Now the mid caps, we're seeing a little bit of improvement there. Again, similar to the NASDAQ, base, second base, breaking out. Here's the New York Composite, same concept, however, looking pretty darn strong. A lot of banks. Small caps continue to stay pretty buried. We really just kind of forming a real sloppy bottom here. Small caps have just been a problem for a while. S&P 500, again, we've got the base, forming a new base, hopefully breaking out. Now, the good news here, we're back above the 35-week moving average on the S&P 500. Also, if we do a trend strength calculation here, you can see that we're getting a reading of 60. So, it's on a scale of 0 to 100. So, NASDAQ is 0, S&P is 60, tells you where the strength is. I went back and showed a historic example using the year 2000 through 2003. Now we can obviously see here that the market really broke down in 2000. All these moving averages just looks like spaghetti going down, real sloppy. But look how it called the bottom in 03. You got a 100 trend strength starting in around April of 03, which was the bottom of the market. So this could be a very valuable indicator. We need to keep an eye on it. Now, also, we're looking at the percent of stocks below their 200-day moving average on the NASDAQ. A little bit of improvement there. We got down to about 14.9. We're rallying up close to around 22 improvement. Here's the percent of stocks on the S&P 500 below their 200-day. We're still not back above 50%, but we're seeing a little bit of improvement after a drop to about 31%. Now, on the yield curve, we're comparing the 5-year Treasury to the 3-month Treasury note or bill. You can see that the long-term interest rates are going up faster than the short-term interest rates, which is good for the bankers, but it's saying that inflation could be an issue. On the aggression index, we're seeing a little bit of improvement there, however, no buy signal. On our 3 economic indicators, the interest rates kind of flattening out around 1.94 on the 10-year Treasury. Oil prices backing off a little bit. Financials are moving up, mainly because interest rates have moved up. Now we've got the new lows. We're getting still too many new lows. On Tuesday, we had 242. You can see we're kind of getting a big group of new lows. That's not a good sign. However, we're going to look at the sentiment readings. And you can see here that we're basically still in fear. Now, this particular survey, which has been a very reliable survey for many years, this survey is done every Thursday, so this will not be updated till Thursday. So what I also did was I kind of changed the indicator a little bit. Being that it's updated weekly, I went to a weekly graph and I'm using a 4-week moving average on the graph. So you can see here that, back in 0809, which was the financial crisis, real extreme readings. It's been very rare for us to get this low. So this is somewhat of a buy signal for sentiment. So that's the good news. Volatility index, same thing. We're seeing, kind of a risk on scenario here. The volatility index, or the VIX, is improving dramatically. Be nice to get it back below 20. It's currently at 20.42. Now we'll get into the top 5 here. This is Zim Integrated Shipping. Very nice uptrend. We do own the stock. Gave a nice buy signal right here. Is consolidating. Also just been in a very strong uptrend, and we're getting a good volume signature there. Alcoa gapped up yesterday, which was Tuesday. We got a gap up, heavy volume. Things like aluminum are looking strong. Devon Energy, we continue to see strength in the energy stocks. Devon holding that 10-day moving average. Then we look at, here is a biotech or a pharmaceutical company called Intra-Cellular Therapies. They're in the drug business for treating neurological conditions. You can see here, nice breakout, volume signature, not way above average, but it's still a volume signature because it's higher than any selling volume for the prior 10 days. Stock is in a very powerful uptrend. Here we have Marathon Oil. Again, this is an integrated company. They actually do refining. Holding that 10-day, continues to be in a strong uptrend. The oils continue to look good. So if you have any questions, let me know. Thank you very much.